Good afternoon, everyone. It's really good to have you joining us online today. For those of you that don't know me, I'm Abi Mustafa Madwakor, the CEO of the African Private Equity and Venture Capital Association, which is the Pan-African industry body that's focused on enabling private capital in Africa. I'm really pleased that we're gathered here today virtually to officially launch AVCA and PenOp's first ever report on Nigerian pension fund engagement with private equity. The increase in commercial capital towards the asset class is key to the growth and sustainability of private capital on the continent. And supporting this is one of AVCA's core focus. So we engage in this study to practically unearth some of the opportunities and obstacles in investing in PE, and fundamentally to bridge the gap between these two complementary industries. Some of the results reveal the positivity of pension fund managers towards the asset class, with 75% of the pension fund managers that participated in the survey planning to accelerate or maintain their current pace of capital commitments to African PE in the next 5 years. In this vein, we've convened this group today to facilitate a conversation between the allocators and the fund managers to bridge the disconnect in perceptions between the two and to practically chart a way forward that accelerates the allocation of pension fund managers' capital to the asset class. We're really pleased to be partnering with PenOp on this initiatives, and we thank the fund managers and the pension fund managers for contributing to this study. So before I hand over to Oguche, I'm just going to go through some of the housekeeping rules, which is just to let you know that today's webinar is being recorded and a link will be shared with you delegates after the event. All attendees will be muted as part of this discussion. We invite you to share your comments, questions by using the Q&A function on your screen, and please try and be as engaged as possible. Without further ado, I will hand over to Oguche. Thank you.
Thank you, Abby. We're very pleased with the partnership with AVCA launching this report. And this report is the beginning of what we think and hope will be a larger partnership to help to bridge the gap between pension funds and private equity fund managers, especially in Nigeria. Globally, there's typically a gap between these two complementary fund managers, but in Nigeria, that gap is a bit wide. And essentially, both of them want the same things in a sense that they both manage patient capital. They both want returns for their funds. But in Nigeria, that connection hasn't been strong. And we're hoping that this partnership with AVCA, starting from this report, will be a bridge. Speaking to local pension fund managers or local private equity fund managers, you hear different reasons of why the allocation is not as high as it should be. And well, this report is a bit scientific and it just brings everything home. It's anonymous, so respondents were frank, and we're hoping that the outcomes from the report will help in further bridging this gap for the benefit of both the private equity fund managers, the pension fund managers, and the economy as a whole. We're also happy to have the Nigeria's Commissioner for Operations, Securities and Exchange Commission, who in essence regulates the activities of the private equity fund managers in Nigeria to give a brief remarks. We'd like to invite Mr. Dayo to give a brief remarks. Over to you, Mr. Obisan.
Okay, thank you very much, Mr. Oguche, and thank you. Good afternoon to everyone. Am I audible? Can everyone hear me? Can everyone hear me? Okay, fantastic.
Yes,
all right, good afternoon, and thank you, distinguished colleagues and friends. Thank you for the opportunity to join you today. The launch of this first report on private equity and pension funds in Nigeria. It's indeed an honor and a privilege to speak to you. And I thank the AVCA and PenOp for the commitment and the dedication to this very important, very, should I say, difficult task, putting all these things together. And thank you all for your extensive efforts to collect and analyze such a wealth of information and producing this comprehensive report. As you all are aware, Nigeria is a popular investment destination in Africa due to its large economy and population size, which has led to a vast number of businesses operating in the industry. Without funds or the promise of funds, investment activity is practically impossible anywhere. In addition to the primary significance of fundraising to a firm, the availability of opportunities for fundraising in a financial system is directly related to and has considerable impact on the growth of the local private equity industry, as this element should typically stimulate both global and local interest in the local PE industry. Private equity firms seek to create economic value by improving management incentives, providing governance oversight, as well as advice on cost cuts on strategic improvements to firms that they want to invest in. Globally, private equity is increasingly becoming an important source of funding for small and medium-sized enterprises, even larger ones. Private equity has a potential to drive economic development and by implication, enable job creation opportunities. In recent years, Nigeria has witnessed a boom in private equity investments. In the African Private Equity and Venture Capital Association's 2020 annual African Private Equity Data Tracker, Nigeria is reported to have struck 50% of PE deals in West Africa between 2015 and 2020. Several players have taken advantage of Nigeria's potential to invest across different sectors. The market is largely dominated by investment from qualified investors that possess large stakes in businesses across the economy, typically through PE funds. In Nigeria, PE funds serve as an alternative source of investment for sophisticated investors and also an alternative source of funds for companies seeking to raise capital through the non-public markets. As of Q2 2021, second quarter of 2021, we have a total of 10 registered PE firms in Nigeria with total committed capital of 58.9 billion, total investment of 24.8 billion, and asset under management amounting to 34.4 billion. Regulatory perspectives. Prior to the financial crisis of 2007 to 2008, private equity firms had operated in an environment devoid of regulatory oversight. The global financial crisis, which led to the threats of near collapse of large financial institutions and failure of some ones, resulting to bailouts by national governments, and dip in stock markets around the world propelled regulators to bring hedge funds, which dragged with it private equity and venture capital under regulatory purview. In line with global trend, the Securities and Exchange Commission in February 2013 released Rule 249D, pursuant to Section 313B of the Investment and Securities Act 2007 on authorization and registration of private equity. The rule stipulates that all private equity funds within the threshold of 1 billion minimum commitment of investors' fund will be subject to SEC authorization and registration. Also, the fund manager of a private equity fund should have a minimum paid-up capital of 20 million. The fund manager is expected to file regular returns on the performance of the fund to the Commission as required by law. The information memorandum should contain adequate information to enable potential investors make an informed decision. There is also restriction to access and further provision that private equity funds should not invest more than 30% of the fund's assets in a single investment. Typically, valuation should be at fair value. The PenCom guidelines for the regulation of investment of pension fund assets gave impetus to the new rules by SEC and by implication, the activities of private equity in Nigeria. And I'll now speak a little bit about the challenges of regulating private equity funds in Nigeria. Increased regulation of private equity will require filling the knowledge gap through knowledge sharing engagements among stakeholders. Adequate and timely disclosures or reporting as to guarantee confidence in the markets. 3, dealing with issues of conflict of interest. 4, enforcement of rules with respect to violation arising from the set rules and PenCom guidelines. 5, the final one, adequate transparency with respect to valuation technique by fund managers. In conclusion, the legal and regulatory framework in Nigeria provides a receptive and enabling environment for a PE fund to set up and make PE investments. Though fundraising, investments and exits may be challenging at the moment due to the impact of COVID-19 pandemic, as well as the economic downturn and security and liquidity issues. The Nigerian economy has proven resilient over the years, and it is envisaged that the country will continue to attract PE investments. On that note, I thank the organizers once again for inviting me to give this brief remarks, and I wish a good deliberation and continued engagement of all stakeholders as we make the PE environment and all stakeholders thrive positively in a well-regulated, efficient framework. Thank you very much. Okay, this is the part I say, Gucci, over to you. No?
Thank you, Mr. Obisan. Sorry, I had some challenges with my connection. We're due to have remarks from the regulator of the pension industry in Nigeria, PenCom, but they're also having some challenges. I guess we'll take theirs later, but we can head on to, I believe, Nadia's bits on the report proper. Thank you.
Yes, thank you, Boucher. Okay. So thank you, Boucher. So as we said, where did we come to the report? So if you move to the next slide, in May 2021, sorry. Yes, so in May 2021, so AVCA partnered with the Pension Fund Operator Association, to PenOp, to empower local investors and develop private equity as an asset class in Nigeria. So the partnership between AVCA and PenOp will focus on training and networking, as well as providing research to support the growth of private equity in Nigeria, especially for pension operators. So as part of this collaboration, PenOp supported AVCA's research and advocacy by providing insight into pension fund investment in PE and their impact. So the Pension Fund and Private Equity in Nigeria report investigates and assesses the role of the Nigerian pension fund in empowering local investors in Nigeria private equity industry. So before I present you the result of the report, I leave the floor to Oguche to present the history and evolution of the pension industry in Nigeria.
Thank you, Nadia. Next slide, please. Yes, so before 2004, the operations of pension funds in Nigeria were very unstructured, and it was a largely defined benefit scheme. There was no regulation, and it was not mandatory. So and it was also very unfunded. But in 2004, when the act was enacted, the Pension Reform Act was enacted, that brought a lot of structure to retirement planning and pension operations in Nigeria, and that made pensions mandatory, both for public and private sector. And that was the beginning of really the pension industry in Nigeria. But with that act, later in the year, the regulator, the National Pension Commission, was established. Before that, there was no regulator, and pensions, like I said, was just unstructured. And then the first pension fund administrators were licensed, and they began operations in February 2006. So the first contributions under the new pension scheme was in 2006. And really, basically, at that time, it was just plain vanilla investments until 2010, when the regulations on investments was expanded to allow pension funds invest in alternative investments like private equity, debt instruments, and superannuation funds. But then fast forward to 2014, July, the Pension Act was then amended. This was 10 years after it was initially passed. That initial one was repealed, and the act was amended. And this also just expanded a number of things the pension funds could do. I think the key provision here was that all profits, dividends, income were tax deductible. So pension funds were able to earn tax deductible income for the benefit of their contributors, and that was quite key. Then in 2017, April, there was also a change to the regulations for private equity funds in Nigeria. One of the key things was moving the amount of the percentage, I beg your pardon, of investments in Nigeria from private equity funds from 75 to 60. Prior to that, it was 75%. So if pension fund wanted to invest in a private equity fund, that private equity fund had to be invested 75% in Nigeria or Nigerian entities. But in 2017, that was moved down to 60%. Something else that happened in 2017 was that the financial statements of either infrastructure funds or private equity funds had to be audited by accounting firms that were registered by the Financial Reporting Council in Nigeria. And then in 2019, February, the regulations were further amended to allow multi-fund structure, to bring forward a multi-fund structure, whereby the pension funds were able to structure their funds according to the age or the risk profile of their contributors. And that has been the evolution since the Act was passed in 2004. And that enabled pension funds to begin to invest progressively in private equity based on regulation. Next slide, please. So there has been a case for private equity investments in Nigeria, and the commissioner for the SEC mentioned some of those things, and we've seen a strong drive towards investments in Nigeria by private equity funds, and that has, you've seen that in the last 5 or 6 years. For example, between 2015 and 2020, Nigeria accounted for 58% of total PE volume in West Africa. In addition, we also accounted for about 65% of VC activity in Nigeria within that same time span. Again, with ease of doing business, the World Bank's ease of doing business, Nigeria has been climbing up, and we sort of moved a whole number of steps up. And a number of these things have driven private equity investments in Nigeria, especially the strong macroeconomic fundamentals, the growing middle class, the relatively stable market, and the large population that Nigeria commands has ensured that private equity funds have invested quite a bit in Nigeria. We've seen that over the last couple of years. That hasn't translated in strong investments by the pension funds. Next slide, please. That hasn't translated in strong investments by the pension funds, and a number of reasons are responsible for this. Number one, pension fund managers they have a fiduciary responsibility, and they will always tell you that because they manage public funds, they are not as bullish as other institutional investors, and they always take a Furthermore, in Nigeria, like a number of African countries, which we'll just see shortly, the allocation to private equity is capped at about 5% versus the allocations to government bonds, which can be between 60 to 80% depending on the fund, or 30 to 60% in money market instruments, again, depending on the fund. But it's just Nigeria and Botswana 10%, Kenya also 10%, Uganda 15%, and some other markets, Egypt, Morocco, a bit unclear, but we've got a small cap, and that probably has one of the reasons that has limited investment in private equity by pension funds. To Nadia to go into that and dive into the report. Over to you, Nadia.
Thank you, Augustine. So should we go to the next slide, please? Yes, okay. So on the methodology, AVCA and PenOp surveyed 22 pension fund managers via an online survey, which was designed to interrogate the viewers' plan and expectation of the pension fund manager about the PE industry in Nigeria specifically, but also in African PE more generally. So we got 68% of response rate, 15 respondents who accumulate 82% of the total value, net asset value of pension asset managed by the pension fund administrator in Nigeria, which means that we covered the Nigeria leading pension fund manager. So who are these pension funds and what is their profile? So to the next slide. Okay, in terms of asset under management, so the pension fund manager profile reflects the significant size of the pension assets. So more than a third, so 37% of the pension fund manager manage more than 1 billion, which shows the growing capital base at their disposal. So for the next slide, on the exposure to alternatives, we observe that despite the extent of assets at their disposal, pension fund investment in the alternative remain relatively low. So in terms of portfolio at the end of 2020, they just have 0.29% of allocation to PE, 0.44% of allocation to infrastructure, and 1.95% to real estate. And another interesting result, but not surprising, is that the vast majority of the respondents, 94% don't have any exposure to the VC, confirming this conservative approach. So next slide. On the geographic commitment, so another characteristic is that more than 80% of the respondents currently have capital commitment to private equity in Nigeria, which is aligned with the current investment guideline for pension fund operating in Nigeria that state that a minimum of 60% of the PE fund is required to be invested in company or project within Nigeria. So this share is reduced to 33% when expanded regionally to private equity in West Africa. And regarding the value of this commitment, we noticed that for the first round. So regarding the value of a commitment, we noticed that 85% of the respondents that have capital commitment to PE in Nigeria have committed between 1 and 20 million, and the largest commitment, so more than 21 million, being concentrating in Nigeria and regional market only. So moving to the planned investment of the pension fund manager. So the report finds that Nigerian pension fund displayed a strong appetite for PE investment, both locally and across the continent, because 75% of the pension fund that participated in the survey plan to accelerate or maintain the current pace of capital commitment to African PE in the next 5 years, and especially a quarter of these respondents plan to increase their allocation to African PE over the next 2 years. And another interesting result is that none of the survey respondents indicated a desire to decelerate the pace of capital deployment to African PE in either short or medium term, which paints an optimistic outlook for the asset class. So what are the drivers for capital allocation? So a vast majority here as well of pension fund managers that plan to increase or maintain their exposure to African PE in the next few years cited a desire for portfolio diversification as a first driver, so at 93%, followed by the performance at So at 53%, the third most popular driving factor identified by the participant was the risk return profile of the PE class. So this could indicate that pension managers are either more comfortable managing the risk return profile of the private equity vis-a-vis their portfolio, or that the perception of high risk associated to the asset class is gradually declining. So we'll have a view of the expert later. On the next slide, the expectation in terms of portfolio return. I'm not mistaken. Okay. Sorry. So in the next 3 years, 53% of the pension fund manager expect African PE return of multiple 2 to 4, so which again paint an optimistic outlook for the asset class. And the respondent that consider too soon to tell in the next 3 years generally have made their first investment between 2010 and 2015. What are the preferences and expectations of the pension fund manager in Nigeria? So the first indicators is the first-time fund manager. So 60% of the survey respondents take an opportunistic approach to investing in first-time GPs, where the likelihood of investment is determined on an individual fund-by-fund basis. And also 30% of survey responded have already invested in a first-time African GP in the last 5 years. Only a small proportion of these, 17%, would likely do so again. This leads us to the following slide, which presents the evaluation criteria of private equity fund. So track record was the most important evaluative criterion amongst those that participated in the survey, 87%. And almost 40% of these respondents view a limited number of established African GPs as a key challenge for pension fund investing in private equity. Also, the participation by a DFI was another important factor highlighted by the surveyed pension fund. Move to the next slide. So the fund manager size, almost half of the pension fund manager have no preference on the size of the PE fund manager, while a fifth prefer to invest in fund manager with 100 million and between 100 million and 250 million in asset under management. We also found that all the pension fund manager that prefer to invest in African fund manager with over half $1 billion in assets under management themselves also currently manage either on equal value or more in pension assets. Concerning the sectors, so although 53% of pension fund managers have no preferences regarding the sector, focus on the private equity fund they invest in, and also 40% prefer to invest in generalist fund, infrastructure was selected by the largest proportion, 87%, as an attractive sector for PE investment in Africa over the next 3 years, followed by healthcare at 67%. And this trend is also confirmed when we analyze the preference of the pension fund that prefer to invest in sector-specific funds, because infrastructure, healthcare, and real estate were also identified as the most attractive sector for pre-investment in the next 3 years. So on the challenges, thank you. A perceived weak exit climate is from far viewed as a significant challenge for pension fund investing in Africa private equity, so 60%. And this echoes to similar concern expressed by the LPs in the AVCA 2021 private equity industry. Also, 27% of the respondents maintain that a lack of information on market activity is a barrier to pension fund investing in Africa private equity, and another fifth points to a lack of regular industry-specific and transparent reporting as another challenge. So AVCA partnership with PenOp attempt to fill this knowledge gap by providing, as we said earlier in the presentation, research and also facilitating trainings and collaboration opportunities for the key stakeholder within the Nigerian PE ecosystem. And finally, currency, political and short-term macroeconomic risks were other challenges identified for pension fund investing in African private equity. We close this presentation with the impact of the regulation, the view. So the next slide is the view of the pension fund on the impact of the regulation. So close to half of the respondents don't consider any other current requirement related to the investment of pension fund asset as an inhibitor of investment in private equity. So this suggests that the current regulatory environment and the investment guideline issues by PenCom are favorable to investment in alternative, at least from a capital allocator perspective. So in terms of conclusion, I would say that the report finds that the Nigerian pension fund displayed a strong appetite to private equity because it is an undeniable source of diversification and performance. The report also highlights that they view the existing regulatory environment as conducive for investment in alternative asset class. However, he points out the perceived weak exit climate and a limited number of established African GPs as a significant challenge. So what is the view of the expert on the necessary development to galvanize more domestic capital for the asset? I leave the floor to Danladi, who is the moderator of the next panel, but above all, co-founder and managing director of Verod Capital Management, and also an AVCA board member.
Thank you, Nadia, for the kind introduction, and thank you for sharing this really interesting report, this survey on pension funds and private equity in Nigeria, which I think is so timely. So thanks to AVCA and for PenOp for your work on this. The pension fund industry in Nigeria currently has $30 billion in AUM, with a permissible limit of $1.5 billion, which can be invested in private equity, which is broadly, investments in unlisted entities, including infrastructure, real estate, and private companies across different sectors. Yet, despite this permissible amount of $1.5 billion, there is approximately $100 million currently allocated to private equity. This is 1/15 the regulatory limit. This means PFAs might be missing out on opportunities to diversify their portfolios, generate higher alpha, and to also participate in the most productive sectors of the Nigerian economy. Yes, I'm a little biased. But I do think that more than ever, private equity is critical for economic growth of the country. And globally, there are very few listed companies that have not attracted and benefited from institutional private capital to fuel their growth. So why in Nigeria are pension funds not participating in the most exciting growth period of a company? Today, we already heard from our industry regulator, who is keen to facilitate pension fund investments into the private equity asset class. And now it's a great honor for me to moderate this panel of esteemed industry experts who will further help us unpack the current concerns and constraints and proffer solutions. I'll introduce our panelists and then we'll jump right into the conversation. In no particular order, Ogedi Onyeama oversees Capital Alliance's investor relations, where she's actively involved in developing and maintaining relationships with investors. Previously, she was a senior manager of the energy and public sector client group at Accenture, where she spent over 15 years. Ogedi graduated with first-class honors in accounting from the University of Nigeria and has an executive MBA from the London Business School. She's a fellow of the Nigerian Leadership Initiative. Gozie Chigbue is a director on the private equity funds team at CDC, the UK Developmental Financial Institution, DFI, and one of the largest and most active DFIs globally. Prior to CDC, Gozie worked in investment banking at BNP Paribas and Corbett Keeling, in equities at CSL, and advisory at KPMG. Gozie is a CFA charter holder and holds an MBA from Manchester Business School. He also studied corporate finance at London Business School. Funso Doherty is the managing director and CEO of Pensions Alliance Limited, PAL Pensions. He was previously managing director and CIO of Value Alliance Asset Management, where he led the asset management business of Capital Alliance. Prior to this, Funso had served as a pioneer managing director and CEO of ARM Pension Managers. While at Pension Managers, he was also the pioneer chairman of PenOp. Funso is a CFA charter holder and is a co-founding trustee of the CFA Society of Nigeria. He's an ICANN holder and studied at Harvard Business School, where he got an MBA. Finally, Doubra Eghaghe heads the alternative desk at Total Closed Pension Fund, where she's currently focused on investments in real estate and private equity. Prior to this, she worked at Sahel Capital, a leading private equity firm in Nigeria. She started her career as a portfolio manager in the asset management industry, working in PHB Asset Management and ARM Investment Managers. Doubra is also a CFA charter holder, I see a pattern here, and has an MBA from IE Business School. Please join me in welcoming these panelists. We'll have 25 to 30 minutes to have a discussion amongst ourselves, and we'll leave 10-15 minutes for Q&A at the end. Please send any questions you have to the chat box, and I or a colleague from AVCA will pick it up. So we'll go ahead and get started. Doubra, we'll start with you. To set the stage, please can you let us know how the investment preferences, risk appetite, and return expectations of pension funds differ to those of other institutional investors?
Hello, everybody. Thank you very much, Danladi. It's good to be here. Thank you, AVCA and PenOp, for organizing this. I hope you can hear me clearly. Okay. So when we talk about institutional investors, I think basically we are looking at pension funds, looking at sovereign wealth funds, endowments, foundations, banks, insurance companies. So all of these companies, all of these institutions have very large base of assets. They typically have long-term horizons. They typically would have regulatory constraints. But of all of these, typically the biggest are usually the pension funds. I think according to research, pension funds hold about 50% of the total investment assets for institutional investors currently, that's globally. But when we are talking about the investment preferences, that is usually shaped by the risk appetite of these different institutional investors. And for pension funds, typically you would hear safety first. I think that had even come up earlier. So you typically hear safety first when we are thinking about how we go about investing pension fund assets. And because of this, you would see the investment preferences tilting towards those asset classes that would give you safety, so to say. So you have a large chunk of investment in fixed income instruments, like in Nigeria, we have almost 80% of the assets in the industry invested in fixed income instruments. You're talking about bonds, treasury bills, and the likes. And then you also think about, I think we talked about the investment preferences, talked about the risk appetite, and also when you're talking about the, I think lastly you asked about, sorry, I'm just trying to get my notes right. So for the risk appetite, definitely we have a lower risk appetite. For the investment preferences, it seems more focused on fixed income instruments and maybe a bit of equities. When we're talking about alternative investments like PEs and maybe real estate instruments, there is less appetite for those because the risk for those are typically higher. So you don't see a lot of interest in those, although we're trying to push for that. I think that is it.
If I may follow on though, you manage alternatives specifically, right?
Yes.
That's CPFA. So can you give us a sense of alternatives you've invested in?
Yes, so for Total CPFA, we are focused currently on real estate investments, that's direct real estate investment and indirect, and also on private equity investments. So we have a couple of private equity funds we are invested in. For us, we are trying to build on the private equity investments. A bigger chunk right now goes to our real estate investments. We have less than 1% in private equity, although we have a limit of 5%. So we're trying to see how we can push more into that bucket. Yeah, but the bulk of it right now is in direct real estate investments.
Okay, thank you. No pressure, Ogedi, but your task with this next question is to get Doubra to increase allocation from 1% to 5%. So, Ogedi, maybe you can talk us a bit about the drivers for the private equity industry in Nigeria and how the risk return profile compares to other asset classes that PFAs might be invested in.
Thank you, Danladi. Absolutely no pressure. And like you, I'm a little biased, but I'll try to set out a view that I know is shared amongst private equity fund managers that invest in Nigeria. And that is that in spite of recent, macro headwinds and what has turned out to be a very challenging environment for raising capital, we hold the firm view that the secular trends, the fundamentals of our market support a really strong medium to long-term growth story, and that there are opportunities to create value and provide very attractive returns to investors through private equity investments. So what are those growth drivers? Historically, it's been about the demographics of our market, the youthful demographics, urbanization trends, which have driven consumption and continue to sustain a certain level of activity and consumption. The infrastructure deficit that also has driven significant public and private sector investments, working to address that. Underserved consumer demand in many sectors, including in tech sector, driving the activity in the tech sectors as well, opportunities to bridge the digital divide and drive digital transformation in various sectors and industries, value chains and markets. And then some interesting opportunities have also been created in interesting sectors, key sectors, including energy and financial services. Opportunities created by reforms that have, sort of then bubbled up opportunities to build really large companies that can, deliver scale. So these fundamentals still hold true. They continue to hold true. They continue to drive growth in the private equity industry in Nigeria, and they create very unique opportunities for private capital to find and back strong management teams in the right sectors and to deliver value and to create value for the market and for investors. Looking ahead, I want to highlight 3 specific things that are more relevant in our current context. So, knock on wood, we're looking forward to eventually settling into a real post-pandemic recovery cycle. And that comes with, an uptick in activity in global markets. That translates to improvements in international trade, in commodity prices, and in global consumption. That translates to real opportunities for private capital in Nigeria as well. I've touched on the tech acceleration trends, but those trends have been sort of amplified in the pandemic and coming out of the pandemic, and we continue to see significant investment activity in some tech-enabled businesses, primarily fintech for now, but also opportunities for private equity alongside venture capital providers to support these businesses as they scale and mature. And then finally, we see that private equity in Nigeria is delivering positive, significant social and environmental impact alongside financial returns. So supported by our investors broadly, that vanguard is led by our DFI investors specifically, but also our pension fund partners. Private equity fund managers and our investee companies are implementing solutions to create impact and alongside economic gains. It's typically in areas of creating jobs, sustaining jobs, supporting financial inclusion, and also increasingly focus on driving, on supporting gender balance. For instance, we saw that in the uncertainty and the difficulties of the pandemic, private equity managers and our investors played a key role in providing capital to our investees to support their businesses and to sustain jobs. So overall, I'd say there's a lot of opportunities to put private capital to work, and private equity is a very, very, very strong platform for putting private capital to work in Nigeria. I'll try to speak to very quickly the second part of the question, Danladi, around the risk return profile. It's been featured in the report on both sides as sort of like a positive. It's very interesting to see a good proportion of respondents identifying the risk return profile or their comfort with the risk return profile as an attraction to continue to allocate to private equity. But Doubra has also highlighted, and I think it's consistent with what we've known historically, that the view is generally the fact that private equity takes pure equity risk is something that is obviously, when you look at the risk return, the risk spectrum sits further along than you would find with fixed income type investments. But in the private equity model, that's a risk that is well mitigated by the fact that you back managers that bring experience in the depth of their teams, in the broad expertise, the sector expertise that they bring to bear, and they work with the portfolio companies in a hands-on, very interventionist manner to implement, whatever strategic objectives are agreed as critical for those portfolio companies. So it's not an unmitigated equity risk. It's an equity risk that is well balanced and well mitigated, considering the private equity model.
Thank you. I'll just follow up with one additional question to you, which is that your firm has probably been the most successful in the industry at raising capital from pension funds. However, what are sort of key challenges you faced? And over the years, have you noticed any trends that you can share with the audience?
Yes. So I would say that what has changed for the better is that given the investment of resources by operators, regulators, including PenCom, operators through PenOp, partners like the GFIs, including the CDC. A lot of work and resources has gone into supporting the capacity of the pension fund market in Nigeria to due diligence and understand what a private equity or other alternative investments entails. So a lot of progress has been made in that regard. We still see that level of comfort with the long-term nature of the returns that come with a private equity investment is an issue, which is ironic given that pension funds have private capital and private equity offers a haven for that private capital and to generate very good returns. But I think that there are some short-term incentives and pressures that make it a little more difficult to deal with issues related to the Jacob element and a general preference and level of comfort with investments that provide a yield, a predictable, almost guaranteed yield. So I think that question remains on the minds of our pension fund partners. What has changed? I think this study also highlighted, very interesting insight that this study has highlighted, and kudos to PenOp and the AVCA team. I think the feedback we've heard over time is that pension fund managers looked at investments in alternatives to provide diversification and access to opportunities that they, being asset managers themselves, would ordinarily not have access to. So when you see a preference for opportunities in infrastructure or healthcare, those more esoteric sectors, I think it reflects that preference for access and diversification that they ordinarily would not be able to provide themselves.
Thanks a lot, Ogedi. Okay, thank you. So next we'll move to Funso. I mean, Funso, there are very few people, if any, in the market today who have your breadth of experience, sitting on all sides of the table. So maybe just for you, I mean, we've heard from the survey about sort of barriers to investing more in this asset class. It surprised me that only 13% of the folks who filled out the survey indicated a lack of internal support as a key barrier, which is great. So what is holding back the other, what's the other 87%? Why aren't we seeing a lot more flowing into this space? Is it a matter of sufficient understanding and comfort with the asset class? Or what are some of the other reasons from your perspective?
Okay, thank you, Danladi. And yes, I have the gray hair to match the experience that you talked about, probably more than I wish to to admit. But I think that a lot of the issues that have been talked about, Doubra spoke about, Ogedi spoke about, I think come into play when when the rubber meets the road in terms of actually committing capital to private equity. I think there's a lot of goodwill. I think there's a lot of buy-in to the concept of private equity. We all know that it's only a very limited proportion of the larger economy that's represented on the stock exchange, which PFAs can invest in directly, for example. So I mean, a lot of these arguments are known. I would say first, it's taking time for people to develop understanding and awareness about private equity as an asset class. And I think a good job has been done by players like PenCom, working with AVCA, PEFCA, ACA did a lot of early work in this area, just trying to increase awareness and understanding of the asset class. So I think understanding has improved over time. Comfort, however, goes beyond understanding, right? So even amongst those who have understanding, a number of those have invested. But ongoing comfort is linked also to those early investments. How have they done? How much comfort is there in sort of driving that, the vanguard of that investment forward. And then how do you broaden? Because initially you will have a group of early adopters, you'll have people who, you know, come on board. Then how do you broaden that to the broader universe of peers? And I think this is where the challenge is. I think the comments about risk return profile and all of that, they're quite important, because remember that these funds that PFAs manage, they're really retail funds, even though PFAs themselves are institutional investors, right? So these are funds that are valued daily. A lot of the investors are, mom and pop basic, investors. They're not necessarily high net worth investors. So the notion of volatility in their pension accounts is also something that is not easily tolerated. So moving away from the what you might call the fixed income asset classes into the variable asset classes, it always has that connotation of introducing volatility into the portfolio. There's an understanding that, that's where the larger returns come from. But I think it's a process for people to develop the comfort of the proportion of the portfolio that they should allocate and allow that volatility to come through in the hope of a long-term return. I mean, we'll talk a little bit more about kind of the experience that people have had and why, the timing, right, of this past 5 to 10 years, which coincides with when PFAs have, sort of introduced private equity as an asset class, and kind of the macro environment that has been represented within those 5 to 10 years, and how those two things interplay, because one must acknowledge that the private equity managers themselves have operated in a very difficult operating environment. I mean, in that period that we're talking about, there are 2 currency crises, for example. So that that has come into play as well. So I think we've seen some growth. I think that comfort, understanding has improved. I think comfort is maybe improving. I think one of the things we can take away from this survey is that the goodwill is still there. People still believe that it's an asset class that they want to commit capital to. The whole notion about risk return profile being one of the drivers is that people understand that to improve the risk return profile of their PFA portfolios, this is something that can help, right, if it operates well. So it's really figuring out how to incorporate it in a way that allows them to meet their objectives. And part of what you see today when people are sort of emphasizing things like infrastructure, emphasizing things like real estate, is a way of, almost mitigating that risk, participating in the space, but in those vehicles or those classes that are sort of lower down that spectrum that Ogedi talked about. And then the structure around those asset classes and those types of funds is done in such a way, and I think Ogedi also mentioned this, is done in such a way that, there's a yield dimension to it, which again is also a mitigant. So, but we can talk more about that as we go along.
Okay, thank you. Gozie, let me go on to you. It was interesting that in the survey, 73% of pension fund managers indicated that the presence of a DFI in the LP base of a GP, of a private equity fund, would be extremely attractive. So beyond PenCom's regulations requiring this, why do you think DFI participation is so important? Can you speak to your participation in various private equity firms and how you collaborated with pension funds?
Thanks, Danladi. It's really great to be here. I think DFIs have a positive and really quite strong reputation with regards to the rigor in our due diligence and investment analysis process, right? And the standards we seek to implement, you know, the track record that we bring, in CDC's case, we're talking about a 70-year track record. And so I think this is viewed as positive and valuable by pension funds and other investors. I think also particularly the governance standards that we seek to implement, you know, when we talk about legal negotiations, legal protections for investors. I think this is also really important for other investors. And finally, you know, there's a halo effect, right? Once you get a DFI on board, the likelihood of fundraising success increases. And so the ability to attract additional capital is also a factor here, I think. And in terms, I guess, more specifically about CDC and what we've done, I think we've engaged very closely with a number of pension funds over the past 5 to 7 years. I'm talking about bilateral knowledge sharing investment papers for completed transactions, obviously with the permission of the relevant fund managers. We've gone on joint due diligence engagements and trips. And I think, as I think about the pension fund industry, Stanbic, IBTC, and Sigma have been very key partners for us, but we've also engaged with PAL, ARM, and a number of other pension funds. And remember, it's a two-way street, right? So we bring our knowledge, a history, a track record to the table, but these pension funds also bring an intimate knowledge of the local investing terrain, of the people we want to back. And so it's not a one-way flow of information at all. It's collaboration and joint engagement. I think other examples, in the past, we've worked very closely with AVCA, with PenCom, with AFDB, with GPs like Africa Capital Lands, Ogedi, Actis, and Cardinal Stone to deliver very targeted training and knowledge sharing sessions to the industry. I think that's a pretty good summary of some of the things we've done, you know, I think from 2016 till now.
Okay, thanks a lot. Thank you. Thank you, and thank you for your support to the industry. Doubra, let me go on to you and just ask, from a regulatory perspective, is there anything more that can be done to incentivize Nigerian PF pension funds to increase the allocation to private equity? And we're nowhere near the cap already, but is there anything else you think that can be done? And then also, could you address Funso's comment about you know, you having to market your portfolio on a daily basis? And then therefore, how do you think of alternatives where, you know, you're getting a valuation change perhaps quarterly at best? And how does that, does that affect how you think about allocating to this space?
Thank you, Danladi. Okay, so to the first part, on the regulatory part, I think quite a bit has been done. So currently, I think for Fund 1, for the PFAs, we can actually invest up to 10%. And then Fund 2, 5%. In our case, we even have a limit of 5%. And like you said, we are not even close to that mark. But I think something else that probably can be looked at, which I also noticed was highlighted in the survey, is the part on the limits that has to be invested outside Nigeria. So we have it with 5% max limits right now for the private equity funds to invest outside of Nigeria. So in our own case, we look at this space as a means to diversify and geographically and also currency-wise. And then we are thinking about it that if only 25% of the funds can be invested outside Nigeria, that is quite restrictive. So probably that can be looked into. I noticed that quite a number of PE funds also have that concern. So if that can be increased, at least it will push for the narrative of us being able to get some geographical diversification from our investment in PE funds. That would be good. Initially, I was thinking around maybe a minimum limit, but I'm not sure if that would fly because, okay, right, as in a minimum limit may be good, but we don't have so many options at the moment. So probably we could look into a minimum limit of, say, maybe over a period, say within the next 3 to 5 years, investment in PE funds should be at least a minimum of 1.2% or something. Yeah, so that could be an option to drive investment into that space, because as it is currently, I can imagine some PE funds are not even considering, although the survey says, okay, there is a lot of appetite, but I also know that quite a number of PFAs would rather just remain in their comfort zone. So they may require some push in that direction, but even with the push, we may also require the regulators to do a bit more of education into that space to even sensitize people on the need for the diversification of our funds away from just fixed income instruments. Okay, then the second part of your question, sorry, can you just repeat it so I can get it more clearly?
I asked about the mark-to-market.
Okay, yes. So for that, for us, it has actually been quite a bit of challenge. So before I even joined Total CPFA, there was a lot of, I think, misunderstanding around that. So we have cases where, because of the valuation, the way the valuation comes in from the funds, you see the PE sector or the PE class of the, when we're reporting our valuation, it is always like negative, as in there is always a challenge on how exactly are we supposed to be reporting this. We're supposed to be marking to market, and apart from marking to market, so there are cases where I think generally understanding the sector is a challenge. Understanding how the valuation is done for the PE space is a challenge for quite a number of PFAs. So the way it's reported, typically you find that where there are commitments or maybe when there are divestments, it is not captured properly, and then that impacts the way it is valued in the books. And it is, most of the time, it is consistently negative. And when presented to the board or when presented to the users of the accounts, it seemed like, okay, this sector is always in the negative. And that's definitely also creates some apathy to that particular sector. So the reporting, the evaluation needs to, there also needs to be some understanding, some education needs to be done in that area. I've tried to do that with my own team. With my, excuse me, with the finance team in my company. I think that's important to look into generally in the PFA space to understand how this needs to be captured properly so that the sector is not always seen as the lagging sector when looking at EV service or other asset classes.
Okay, thank you.
Answer the question. Okay.
Yeah, yes, it does. And maybe as a follow-on to that, Funso, maybe I'll throw this back to you. This will be two parts. One is just addressing this piece about lower valuation, and my guess is that's probably in the early life cycle of a fund. So that's the J-curve effect. A question came through from Brian Yala asking if private debt or credit would not present a more palatable option for pension funds to avoid this J-curve effect. So that's one. The second question I'll ask you to please answer as well is, you know, globally, we're seeing just a massively increasing interest in the VC space, globally, as well as in Nigeria. I think every day we wake up and there's another unicorn almost, or at least every week, right? And valuations are going up 10x, 15x. Yet according to the survey, not one pension fund manager is invested in the VC space. Why do you think that's the case? Do you think there's scope to at least, you know, just wet toes a little bit and begin to understand that space by making some commitments? Or what do you think it'll take to make a commitment to that space?
Okay, thank you, Danladi. Both good questions. I think that, you know, the question of VC, let me start with the second question first. You know, I think that there isn't a fundamental or shall I say philosophical objection to VC investments. And if you think about VC more broadly as sort of investments in private companies, similar to private equity, but just at an earlier stage. And indeed, if you had vehicles that were structured such that they met the the investment guideline requirements or of the vehicles, type of vehicles you could invest in. So typical private equity fund structure, maybe targeted at earlier stage companies. In theory, that might not be something that is outside of our reach. However, I think the challenge with VC is that VC investments, as you know, are very, shall we say, there's a great deal of dispersion around VC. So, these are early stage companies. It is not clear which ones may succeed or not succeed. In many cases, they may not be profitable. They may not be revenue generating. I mean, we all know the various things around this. Now, all of those are not necessarily bad. It's the nature of the investment, right? However, what I think complicates it in the case of PFAs in Nigeria, or PFAs who would be looking to do such a thing in Nigeria, is that, if you add to that uncertainty, just the uncertainty around the range of outcomes of early stage companies, if you add to that uncertainty the fact that, and this goes to some of the things I mentioned in the report around, the death of GPs, right? If you add to that the fact that you can't really sort of pick out a GP that you might say, has specialized in doing venture capital investments and has demonstrated, that they've done this and done it successfully. So when you those two things then compound one another, right? So the underlying asset class has a great deal of uncertainty and dispersion, and you don't have any sort of guiding hand that you can say, okay, I can go with these guys because they know the space, they know the companies, they can pick it out or whatever. So it then becomes an intractable thing for you as someone sitting in a pension fund seat to think about how you allocate money to that class. So I guess that's the challenge that I would throw out to folks who are, the managers in that space. That these really are sort of the challenges, and if there's a way to figure that out, I mean, everybody wants to participate in the next unicorn, right? Although nobody talks about the maybe 9 or 10 or 12 entities that go bust or maybe more for every very successful outcome. But it's the job of the manager to help us understand those companies and understand which are the right companies to invest in. It's just that, we will look at those two things together, the underlying asset class and who is there to help us deal with and manage the assets in that asset class. And I think that's the challenge for VC. You're going to have to remind me of the first question, Danladi.
The first question was meeting the J-curve challenge by investing in debt funds, exactly.
Okay, so I think that in a sense, this is another approach or way in which this this risk return profile thing is being dealt with. I mean, one of the things that you see, for example, is that there's interest in these infrastructure debt funds. We have a lot of PFAs who have participated in those instruments. Essentially, those are entities that invest in infrastructure type assets, even though we define it very broadly, I think, in this context in Nigeria, but structured in such a way that it is debt that's been sort of lent to the target companies, and then the underlying vehicle itself then becomes a yield bearing or yield paying vehicle. And those have actually accumulated quite a bit of capital. So the answer, I think, is yes. There's evidence that that is happening, and I think those types of vehicles, to the extent that they've been in for a while and they've operated for a bit of time, have found it easier to kind of I think grow those funds. I will say that ultimately the long-term outcome of those funds goes beyond just the yield that you're getting, right? So time will also reveal the full range of outcomes and return that we generated from that activity. But to the extent that they're demonstrating some current yield, they're getting quite a bit of interest.
Okay, thank you very much for that. That was very helpful. Another question came in, which is exit, exit, exit. It's one of the biggest challenges to PE funds that PE funds are facing in Nigeria. Equity markets are shallow and liquidity is difficult. Ogedi, maybe I'll turn this over to you just to tell us how you've approached exits. Are there any creative options, or sort of how do you see the exit opportunities in the near term?
Yeah, so Pabina hits on a very on a critical pain point for private equity and other alternatives investments in Nigeria. It's yes, indeed, the capital markets are thin. Yes, indeed, there have been, we haven't had as many of the traditional exits as we would have liked to see, including IPOs, etc. There have been a few successes, and we point to, for instance, the MTN story. It's taken a while, but we've gotten to the point where ultimately that has contributed to delivering an exit for investors, including ourselves, who supported MTN from inception, and also deepening the market, serving to deepen the capital market by bringing in a company of that scale and of that attractive level of attractiveness. More recently, we've also looked at using structured instruments. So one of our portfolio companies that is recently on track to deliver at least 1x in a relatively short period of time, just from being able to sweep cash back through the structured instruments that was used for that investment. So there are a couple of creative options that managers are looking at, but at the end of the day, the truth is that a good company will find buyers, no matter how difficult the exit environment is. So the challenge is to build really good companies that are attractive.
Thank you. Just as a follow-on to that, actually, I think it's a nice segue to the next question we got, which is how do we have a paradigm shift? We're not just looking at returns, economic returns, we're also looking at impact, right? Impact was noted as one of the key drivers of allocation on the report. However, it's not clear that it truly is a very important metric. So what needs to change for this to happen? Maybe I'll ask Gozie this question coming from a DFI. Gozie, I at least can't hear you. I can't hear you. Can anyone else hear Gozie?
No, we can't hear Gozie, unfortunately.
Okay. No, we can't.
Okay, better now. Yeah.
Better?
Yes, now we can hear you.
Okay, thank you. Okay, so I think this is a really important question, and the way I'll address it is, if we think about the impact of ESG and gender on returns, and whether there is a trade-off or not. I mean, what we found is research has shown that you get better exit outcomes when you address ESG in your investment, because I mean, if you think about resource and energy efficiency, it adds to the bottom line, and it also adds to your exit price. If we think about the decisions that are made at boardrooms, once you have the right sort of gender balance, you end up in much better outcomes, much better profitability. So actually, there is no trade-off. If anything, you get better outcomes by factoring impact and all the different ramifications of impact into your thinking as either an investor or an operator of a business. I'm not sure you actually heard me, so I'm going to check again. Okay, yes. Yeah, so I mean, and there are lots of good examples in our portfolio. I mean, we've spent a lot of time we've got a really strong team at CDC that spends time doing the research and evaluations of these sorts of issues. And that's why we try to build these key issues into our thinking around investing, whether it's around the sort of investors we back. I talked about gender, but there's also a case for backing indigenous businesses who are better connected to the environment and better able to tailor products to the appetites and needs of the consumer base, to thinking about governance and the right sort of board structure, the right sort of governance that you need to enable you have a clean exit at the end. And it's a really important issue. But I really want to assure, we really want to assure the audience here that there is no trade-off. You actually end up with better return outcomes by embedding these factors into your thinking.
Thank you. Thank you. Another question came in, and I think this is really good. And I just think it just speaks potentially the heart of the matter. And it basically says, I think the perspectives of creating more awareness or understanding of the private equity asset class is overflowed. PFAs today understand PE. The key issues are, are managers really performing, right? Being more transparent about underlying performance, providing co-investment options, and I guess just overall transparency. Doubra or Funso, would you be able to speak to this a little bit? First of all, do you agree? And then, and if so, can you just add to that thought process?
The question being around performance and transparency.
Yes.
I think that the question of performance is, I think it's come through in some of the discussions we've had today. It's not a non-issue; it's an issue, whether you call it performance, whether you talk about exits, they're all sort of linked to one another. And at the end of the day, it's really around, the private equity asset class is generally sold around, you invest over like a 3 to 5 year period, and then you get your money back over the subsequent 3 to 5 years, and you get a lot of, but by the time you look at what comes back from what you put in, you get a very good return, promise of it. And I think that, the period that we talk about, within which PFAs have generally become more active participants in private equity, have been periods that have been challenging, when you think about the outcomes in some of these. So I would say the outcome of that participation has been mixed, right? So in essence, even though in looking at the report today, you see that the goodwill and all of that is still there. People intellectually understand it, but it's a global phenomenon that when things do well, money chases it, and when it doesn't do so well, or when it's a challenging time, people may understand and buy their time, but you may not see a lot of money, sort of flowing into that space. And I think that, in a sense, that's part of a shade of what I think we are seeing today. So I think that, for example, if we had blowout returns, the whole notion of understanding, and comfort will become back burner issues, and people will sort of chase those returns, and people sort of follow what is doing very well. So we understand the challenges that underlie it, but in truth, you expect that to be a feature. Transparency, maybe. I mean, I don't have much of a view on this. I think a few of the players that I am more familiar with who are perhaps the established players within the field, are fairly transparent, and are willing to answer the questions that you ask. However, it is what it is. So, I mean, that does not change or will not change, the outcomes that we speak about here. So these are sort of my sense of those two things.
Okay, thank you very much. We are running out of time, so we have to wrap up this panel, but it's been really exciting and I think overall a fantastic session. So just want to thank all the panelists for their candid comments, for their time and for their openness. I want to thank the audience as well for being very engaging. There are a couple more questions that came through. We will probably try and get the answers back to you individually, to the audience members who asked those questions. Next, we will move on to hear from Mr. Dahiru Abdulqadir, who's representing the head of the Investment and Supervision Department at PenCom. We look forward to hearing his comments. Thank you.
Thank you, Mr. Danladi. Am I audible?
Yes, you are.
Okay. Thank you very much for giving the Commission an opportunity to make a few comments. And like Mr. Danladi rightly said, I'm standing in for the head of investment supervision, who could not join us today because she has other prior engagements. So I will read her remarks. So the National Pension Commission is quite pleased to be represented, to be invited to the launch of the report on private equity investment by pension funds in Nigeria. It is worthy to note the partnership between PenOp and AVCA has culminated in the report that is being launched today. And the Commission is optimistic that this engagement will be constructive, pragmatic, and that actual outcomes will be in line with stated objectives. You may have noticed that portfolio allocation to PE investments by PFAs has remained significantly below the regulatory requirements of maximum of 10% for Fund 1 and 5% for Funds 2 and Fund 6 active. The pension industry allocation to private equity space as at 31st October 2021 was only 0.28%, equivalent in Naira terms to about 37 billion. This low allocation to this potentially beneficial asset class limits the pension industry's ability to reap the diversification and return benefits that investment in private equity provide. In our experience at the Commission, lack of understanding of the potential benefits of PE investment by PFAs, though important, is not the only impediment to increasing allocation to this asset class. Other factors include the level of transparency of PE firms, limited number of PE opportunities that qualify for pension fund investment, and lack of industry-wide capacity in terms of skills and knowledge needed for due diligence and evaluation of the economic potential of PE investments. It is therefore commendable that the collaborative study we are launching today discusses the PE landscape on the continent, with a specific emphasis on the Nigerian experience, the key market drivers for PE investment, and also attempts to provide information that could bridge the gap between the needs of pension funds and private equity firms. The particular focus on evaluating and understanding the investment behavior of pension funds will be helpful in assisting PE firms develop opportunities that meet the needs of pension funds and ultimately help to increase industry allocation to this very important asset class. It is the hope of the Commission that this collaboration between AVCA and PenOp will be to the mutual benefit of both the PE firms and the PFAs. It is expected that the collaboration will foster a better understanding of the pension industry and help private equity firms to structure products that better match the regulatory requirements of the pension industry. Furthermore, We expect that pension funds are also able to learn more from the continuous interaction with AVCA, and that the pension industry will be better for it at the end. Thank you for your attention. Mr. Obuchi.
Thank you, Mr. Dahiru. Thanks for your comments, and thank you for the support that PenCom has given. PenCom is, as part of their 5-year strategy, one of the fulcrums is to be able to drive diversification for pension assets. Thank you. Thank you. At this juncture, we can hand over to Anna, Evie Parker, I believe. Abi, am I correct? Is it time for Anna to make her remark?
Yes, you're correct.
All right, Anna, go ahead.
Thank you, Oguche. Thank you, Abby. Good afternoon, everyone. I'm Anna Parker, Executive Secretary of the Private Equity and Venture Capital Association of Nigeria, PEVCA, which is the body responsible for promoting the PE and VC ecosystem in Nigeria. We'll close off this session by saying, first of all, a huge thank you to AVCA and PenOp for putting together this much needed inaugural pension funds and private equity report, which is an extensive study highlighting the standing of the relevant stakeholders and providing insight into both sides of the conversation. The perspective of both pension fund administrators as well as private equity funds in this study does provide a very balanced research. This study not only brings to the fore the current standing of pension fund allocation into PE funds in Nigeria, which I'm sure we'll all agree is still minimal in comparison to total assets, but also does a great job of providing familiarity into this asset class and highlighting the viability and feasibility of investments into private equity. One of the key benefits of this study, I think, is showing that private equity does have a place within portfolios of pension funds for several reasons, but primarily for portfolio diversification and the generation of higher returns over time. From continuous engagement with our PE fund managers at PEVCA, we know that fund managers have a strong will to raise local capital. We recognize the importance of attracting local pension funds for the long-term sustainability of the PE industry in Nigeria, especially given the crucial role of domestic capital in accelerating economic growth. Consequently, over the last few years, PEVCA has made efforts to engage with PFAs in smoothing out and simplifying this process by providing familiarity of this relatively new asset class, while also making attempts to address some of the other challenges which have also been raised and highlighted in the study. So we're very grateful to AVCA and to PenOp for taking this huge step in the process of bridging the gap. It is the first of many steps to come. Going forward, I'm sure that this study will be useful to PE fund managers who wish to raise local capital from pension funds as they engage with PFAs, as well as the PFAs who seek better understanding of the asset class. Without doubt, this will encourage continuous interactions between both parties, interactions that we hope will progress even beyond fundraising. Our hope is that as we continue to engage with PFAs and demystify the asset class, PFAs will make explicit commitments to provide local capital to private equity funds, and that pension funds will eventually be a top investor group for PE funds in the country. We look forward to seeing a significant increase in pension fund allocation to the PE funds in the near future, and ultimately the acceleration of economic growth in the country. Thank you again to everyone involved in the process of making this happen. Thank you. Abby?
Thank you so much, Anna. Once again, thank you very much to all the panelists. Thank you to the delegates for joining, for your engagement. As my colleague has mentioned in the chat, we will share the report with everyone following this discussion. So thank you very much and hope to see you soon. Take care.
Thank you, Abby. Thank you, everyone.
Thank you.